Accounting is the language of business, and it's definitely a language that you need to know if you want to progress in your own business or eventually invest in other businesses and just kind of understand what's going on, right? However, you don't necessarily have to be an accountant to fully understand what the financial statements are telling you. So we're going to walk through the different statements that there are in accounting, the ones that your accountant may give you on a monthly basis. We're going to learn how to read them and how they talk to one another so that we can use them to make decisions going forward. So the three main financial statements are the balance sheet, the income statement or the P&L, and the statement of cash flow, which we're going to use last. The best thing about accounting is these statements do not really change from one company to the next or one industry to the next. They all still say the same thing. However, depending on how good of an accountant you have, how professional of an accountant you have, you're going to have different line items and different things in each of these statements that tell you a different story. So that's why it's so important to have an accountant that understands your industry and knows what's going on, so that when you're looking at these different financial statements, it's telling you what you want, not just giving you a baseline of some general data, okay? We're gonna start with the balance sheet. The balance sheet's a very important statement, and it gives you the balance of different parts of your business at a point in time. Things like, what's my cash balance today? What is my debt balance today? What is my company book value today? And the balance sheet is made up of three main areas. And the first area is assets. Assets are things like cash balance or accounts receivable, or things that you're able to use in the company that increases the value of the company. Trucks, for example, in a moving company, or a warehouse, all are examples of assets in a company. If we want to know the value of the things that a company physically has in their warehouse or on their site, we look at the assets of the balance sheet, and that's going to tell us the value of those things. You also may see a line in the assets section of your balance sheet that is a negative line for depreciation. And all depreciation is the reduction of value over time of those assets. All assets lose value over time other than land, and we show that reduction of value through accumulated depreciation. The second part of the balance sheet is the liabilities section of the balance sheet. Liabilities shows the section of your company where you owe money. Things like you buy inventory on payable, meaning you have a bill that you have to pay later. You receive the inventory, but you still owe on it. That'd be a liability. Or if you have a truck that has a loan on it, that loan is the liability for the company. For a moving company, primarily most of the liabilities are loans on vehicles. Since vehicles are the main asset used by a moving company, usually those liabilities coincide with the biggest asset of the company, which are moving trucks. And then at the end of the balance sheet, we have something called equity. And equity is the net value of assets minus liabilities. The accounting equation, as accountants, we have an accounting equation. The accounting equation is assets minus liabilities equals equity, or owner's equity. Equity is also the book value of the company that you own. If we ever want to look at the health of the value of a company, oftentimes we'll look at what the equity balance looks like, because that equity shows how many assets that you have that do not have debt or are used as collateral for the value of that company. It's also important to note that equity is what you can take out of your company through things like owner's draws. If you don't have any equity, then you're also not able to take any owner's draws. We're not going to go into any tax forms or tax items today, but one of the big items is basis as it relates to owner's draws. A lot of times moving company owners will have very, very small basis or negative basis, and you can't take owner's draws against a negative basis, or else you get taxed on that. So that's the balance sheet section of your company, a very, very important section that oftentimes gets overlooked. The next section, which is a section that most moving company owners are familiar with, is the P&L, or the income statement. Those statements are used interchangeably. This shows for a duration of a period of time what is the outcome of the operations of the company. Whereas the balance sheet shows the balance of something at a point in time, the income statement, or the profit and loss, shows revenue or expenses over a period of time. What is your revenue for January? What is your revenue for the year 2025? Whereas a balance sheet says, what is my cash balance today? What was my cash balance yesterday? That's how you can kind of differentiate between an item that's going to be a balance sheet item and a P&L item. The top of the income statement includes your revenue. Revenue is all of the inflows from operations of the company. Anytime you perform a move or you have storage revenue, that's income, that's revenue, and that goes on the top of the income statement. Oftentimes we look at revenue, and as accountants, we see revenue as a vanity metric because we have all of these other items that are included on the income statement that reduce the impact of revenue on our company. So while it's important to have revenue, and you don't have a business without it, it's also important to be looking at the other sections of the income statement to understand where that revenue disappears. And the first being cost of goods sold. We abbreviate cost of goods sold by just saying COGS, cost of goods sold. And cost of goods sold, specifically in a moving company, include the items that a moving company needs in order to generate revenue. Not generate leads like marketing, but generate revenue. What we include here at ProMover Accounting are things like your labor costs, your truck lease and rent costs, fuel costs, things like that that are required to be used and expend in order to generate revenue. One of the other big reasons as to why we have cost of goods sold is because it allows us to understand what our costs will be as our revenue rises. There's some expenses that don't increase while our revenue rises, and there's some that are. And any expenses that do rise perfectly in tandem with the increase in revenue almost universally go into cost of goods sold. And so when we take our revenue and we reduce our cost of goods sold, that equals our gross profit. Gross profit then is the remaining cash that we have to pay for all of our overhead costs. And our overhead costs are things that are relatively fixed. Things like warehouse rent, utilities, which fluctuates throughout the year, but they do not really increase while your revenue increases. Software costs. Most software costs don't increase when your revenue rises as well. Usually they're based on users. So while your revenue rises, most software cost stays about the same. So then when we have our gross profit, we have that to pay for our overhead costs. So the next line on our income statement, naturally, is overhead expense. Overhead expense usually remains pretty consistent throughout the year. So it's really easy then to back into how much revenue we need in order to make sure we have enough gross profit to cover our overhead expenses. So we start with revenue, we pay for our direct cost, that gives us gross profit. After our gross profit, we pay for our overhead expense. And once all of our overhead expense is paid for, we're left with net income. Net income then is the money that we have left over from our revenue after paying all of our direct costs, cost of goods sold, and our indirect costs, our overhead expenses. Whatever is left then, we get to use to either reinvest back in our company or we get to pull it out as owner's draws or dividends. So now that we have those two statements and we're resolving with net income, that's great. We have net income in the company. The problem is net income doesn't tell the whole story. We need to reinvest in our company through that net income. So while net income is great, that doesn't reconcile to our cash balance. The statement that we use to reconcile to our cash balance is called the statement of cash flow. The statement of cash flow is really a reconciliation between the balance sheet and the P&L. We use cash that's from net income to pay for items in our balance sheet that help us improve our company and grow our company over time. So if we want to understand what our cash flow is going to look like into the future, we can project what our net income is going to be based on what our revenue will be and our direct costs, giving us gross profit margin, and then covering our overhead costs, we're left with net income. We take that net income then and figure out what we're going to do with that net income from the balance sheet. The balance sheet allows us to buy assets. It allows us to pay down liabilities. And also it allows us to take dividends. So while revenue is important, what's more important is net income. And while net income is important, what's more important is cash flow. So in the end, we have all of these statements that combine into the cash flow to allow us to see how our cash has changed throughout the company and what else we have to add into the net income to understand where our cash is going to go. And those are the three most important financial statements that we can look at to continue improving our moving company.